The year is 2025. The global economy is still recovering from the shocks of the early 2020s. Yet the specter of trade wars has re-emerged. Former President Donald Trump, a vocal critic of globalization and free trade, has once again raised the possibility of imposing new tariffs on goods from China and other countries. These threats, if carried out, have the potential to ignite a new era of trade conflict. Trump's return to the political stage has been marked by a familiar refrain: protectionism. He argues that previous trade deals have hurt American workers and businesses. His solution? Tariffs. These taxes on imported goods are designed to make foreign products more expensive, thereby boosting American industries. However, economists warn that tariffs are a double-edged sword. While they may offer short-term protection for certain industries, they inevitably lead to higher prices for consumers. Moreover, tariffs often provoke retaliation from other countries, setting off a chain reaction that damages the global economy. The interconnectedness of the global economy means that a trade war between major powers has far-reaching consequences. Tariffs disrupt supply chains, raise prices for consumers, and create uncertainty for businesses. This can lead to a slowdown in economic growth, job losses, and market volatility. The International Monetary Fund, or IMF, has warned that a full-blown trade war between the United States and China, the world's two largest economies, could shave off a significant percentage of global GDP. The effects would be felt not only in these two countries, but also in Europe, Asia, and developing economies that rely on trade for growth. The uncertainty created by trade wars can also have a chilling effect on investment. Businesses may postpone expansion plans or hold back on hiring, fearing that the rules of the game could change at any moment. This can further dampen economic activity and hinder long-term growth prospects. In the crossfire of a trade war, both businesses and consumers find themselves caught in the middle. Businesses face higher costs for imported raw materials and components, which they may have to absorb or pass on to consumers in the form of higher prices. Consumers, in turn, see the prices of everyday goods and services rise, eroding their purchasing power. This can lead to a decline in consumer spending, which is a major driver of economic growth. Moreover, tariffs can distort markets and lead to inefficiencies. When protected from foreign competition, domestic industries may have less incentive to innovate and become more competitive. This can result in lower quality products and reduced choices for consumers. History is replete with examples of trade wars and their harmful consequences. The Smoot-Hawley Tariff Act of 1930, which raised tariffs on thousands of imported goods, is widely seen as having exacerbated the Great Depression. More recently, the trade war between the United States and China in the late 2010s resulted in billions of dollars in losses for both economies. The path forward lies in cooperation and dialogue, not confrontation. The world's major economies need to work together to resolve trade disputes through negotiation and compromise. This includes strengthening the rules-based trading system embodied in the World Trade Organization, or WTO. Ultimately, the goal should be to create a free and fair trading system that benefits all countries. This means addressing legitimate